Welcome to today's video. We're tackling a common misconception. The idea that making a big extra payment toward your mortgage principal will immediately lower your required monthly payment on a standard fixed-rate loan. In reality, that's not how fixed payments work. Instead, prepaying principal speeds up payoff and cuts total interest, not the minimum due. We'll explain the math, show when and how to request a loan recast to actually reduce your bill, and compare recasting to refinancing and investing. Finally, we'll close with key takeaways, a quick quiz, and a short disclaimer. Here's the plan. First, we'll outline the myth versus the reality. Next, we'll explain how fixed mortgage payments really work and why prepaying principal doesn't lower the minimum due. Then we'll introduce recasting, the proper method to reduce the required payment. After that, we'll walk through step-by-step instructions for requesting a recast, compare recasting with refinancing, and run through a numbers-based example. We'll also discuss situations where prepaying might not be the best use of cash. Finally, we'll review key takeaways and test your knowledge with a short quiz. Let's begin with the myth. Many borrowers assume that if they put a large lump sum toward their mortgage principal, the bank will automatically reduce their next minimum monthly payment. However, with standard fixed-rate mortgages, your required monthly payment is set when you sign the loan. Prepaying does not change that minimum by default. Instead, it shortens the timeline to pay the loan off and reduces total interest. Here's the logic. In a fixed-rate mortgage, your minimum monthly payment is calculated at origination based on the original principal, interest rate, and term. When you pay extra toward principal, the loan balance drops, which means less interest accrues going forward. Consequently, more of your future regular payment will go to principal, and you shorten the loan's life. However, the contractual minimum amount due does not change simply because you prepaid. The benefit of prepaying is accelerated amortization and interest savings, not an automatic reduction of the monthly bill. If you want a lower required payment after a lump sum, you must ask your lender for a recast. To actually reduce your minimum monthly payment after a lump sum principal payment, you can request a loan recast. In a recast, the lender recalculates your payment based on the new, lower principal, while keeping your existing interest rate and remaining term. This results in a lower required payment. However, recasting is not guaranteed. Some lenders don't offer it, and many charge an administrative fee. Therefore, before making a large extra payment expecting a smaller bill, confirm your lender's recast policy and process. Here are the steps. First, contact your lender or loan servicer to verify whether recasting is offered and what the eligibility criteria are. Second, ask about the minimum lump sum amount required and the recast fee. Third, make the principal prepayment exactly as instructed, ensuring it is applied to principal. Fourth, submit the formal recast request, along with any required documentation. Fifth, wait for the recalculation and approval from the servicer. Finally, once processed, you will receive a new payment schedule reflecting the reduced required monthly payment. This timeline summarizes the process, from initial contact to the first reduced payment. Typically, after you verify eligibility and fees, you make the lump sum payment, submit your recast request, and the servicer recalculates your required payment. In many cases, the new amount appears in the next billing cycle, or the one after. Exact timing depends on lender processing timelines and whether additional documentation is needed. Let's compare recasting and refinancing. With a recast, you lower your payment by recalculating it based on a reduced principal while keeping your current interest rate and remaining term. The cost is usually limited to a modest administrative fee, but you must provide a lump sum prepayment. Recasting is typically quicker and requires less documentation. In contrast, refinancing involves taking out a new loan, which can reduce your rate and payment but requires a full application, underwriting, and closing costs. Refinancing may extend the loan's term and reset amortization, which can increase total interest if you stretch payments over a longer period. Let's walk through numbers. Suppose a $500,000 loan at 6% for 30 years. The original monthly payment is about $2,997. After 5 years, the remaining principal is roughly $465,000. If you make a $100,000 lump sum prepayment, your balance drops to about $365,000. If you do not request a recast, your required payment remains about $2,997, but your remaining term collapses to around 188 months, meaning you pay off the loan much sooner and save substantial interest. If you do request a recast, The lender recalculates your required payment using the new balance and the remaining 25-year term. That produces an estimated new payment around $2,352. Actual figures vary by exact dates, compounding, and lender calculations. This pie chart illustrates the typical breakdown of the very first payment on a $500,000 loan at 6%. About $2,500 of the payment goes to interest, and roughly $497 goes to principal, meaning approximately 83% interest and 17% principal. Over time, as the balance declines, the interest portion decreases, and more of the payment goes to principal. This dynamic is why lump sum prepayments reduce total interest over the life of the loan, even though the minimum payment stays the same, absent a recast. This mind map starts with your primary goal, lowering your required monthly payment or simply saving on interest. If you need a lower required payment now, the branches point to recasting or refinancing. Recasting keeps your existing rate and term, but requires lender approval and a fee. Refinancing replaces your loan entirely, potentially yielding a lower rate at the cost of fees and a full application. If you don't need to lower the required payment, consider prepaying to accelerate payoff and save interest, while the minimum stays unchanged. Another branch explores investing your extra cash instead. Here you compare the potential risk-adjusted, after-tax return to your mortgage rate while considering liquidity and emergency funds. The caution notes emphasize confirming recast availability with your lender and maintaining adequate cash reserves. Quiz time. The question is, on a standard fixed-rate mortgage, will a large principal prepayment automatically reduce your next required monthly payment? Here are the options. 1. Yes, the payment automatically drops. 2. No, the payment stays the same unless you recast. 3. Only on variable rate mortgages. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is no. The payment stays the same unless you recast. Prepayments accelerate amortization and reduce total interest, but your contractual minimum monthly payment remains unchanged unless the lender recalculates it through a recast. Second quiz. The question is, you made a $100,000 lump sum principal payment and want a lower monthly bill. What process should you request from your lender? Your options are a loan recast, a rate buydown, an automatic payment reduction, or a short refinance. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is a loan recast. A recast prompts the lender to recalculate your payment based on the new, lower principal and the remaining term, which typically lowers the required monthly payment. Before prepaying, consider your broader financial picture. Maintain sufficient liquidity. Many advisors recommend 3 to 12 months of essential expenses in an emergency fund. Compare your mortgage rate, after tax, to the risk-adjusted returns you might earn by investing. In lower-rate environments, investing can potentially build more wealth. Consider your risk tolerance and time horizon before tying up cash in home equity. Avoid prepayments if there's a chance you'll need to borrow those funds back at higher rates or with fees later. Finally, think about diversification. Home equity is illiquid and concentrated. Balancing it with other assets can improve flexibility. This video is for educational purposes only and does not constitute financial, legal, or tax advice. Mortgage contracts, lender policies, fees, and rates vary. Always consult with your lender, a qualified financial advisor, and a tax professional to evaluate options based on your specific circumstances. Here are the key points. First, prepaying principal on a fixed-rate mortgage accelerates payoff and reduces interest but does not lower the contractual minimum payment. Second, to reduce your required monthly payment after a lump sum, you must request a loan recast. Third, recasting is not automatic, and lender policies and fees vary, so confirm in advance. Fourth, refinancing is another route to lower payments but comes with costs and a full application. Finally, weigh liquidity and potential investment returns before prepaying, especially when mortgage rates are relatively low. To wrap up, we debunked the myth that extra principal automatically reduces fixed mortgage payments. We explained that a recast is the mechanism that can lower your required payment after a lump sum, subject to lender approval and fees. We emphasized confirming lender policies ahead of time and understanding timelines. Finally, we encouraged you to run the numbers carefully and to consider whether investing excess cash may offer a better risk-adjusted return than prepaying, depending on your mortgage rate and goals. Thanks for watching. If you found this useful, please like the video, share it with someone who might benefit, and subscribe for more practical finance insights. We'd love to hear your experiences and questions in the comments. What has your lender said about recasting, and have you run the numbers on prepaying versus investing?